The US will be well served to capture as much of the crypto market as humanly possible. Those stablecoins will keep eating more of the treasury market. Stablecoins as a group were the 18th largest holder of US Treasury, above Japan and below Germany. Treasury-backed stablecoins are definitely going to grow, which through the Genius Act, the US government is highly encouraging. The question is, does your financial system have the best stuff for them to choose from? And if enough of them are in your financial system, then your financial system is really important.
Our guest today is Sergey Nazarov, the co-founder of Chainlink, the industry standard blockchain oracle network. Chainlink has become the critical infrastructure powering over $25 trillion in transaction value, connecting smart contracts to real-world data across 60-plus blockchains. Major institutions, including the U.S. Department of Commerce, rely on Chainlink's technology. Sergey himself was present with Donald Trump and other U.S. regulators a few months ago during the summer when the Genius Act was signed into law. We'll be getting his take on what the Genius Act means for the future of global finance, what's next for U.S. legislation that could completely change DeFi and cryptos, and what's next for blockchain adoption in our society. Welcome to the show, Sergey. Good to see you today. Thanks for being here.
Happy to be here. Thanks for having me.
I want to start by talking about something that's been on a lot of investors' minds, how the Fed pivot is going to affect DeFi. So the Fed, as you know, cut their lending rate by 25 basis points last week. We saw crypto markets initially rallying in response and then dip. From your perspective, running critical infrastructure on DeFi, traditionally, how has DeFi reacted, or what goes on under the hood when monetary policy shifts?
So the yield you can get on the US dollar in DeFi is, I think, anywhere from 5 to 14%, depending on the protocol and how they do something called looping. Generally speaking, if the Fed funds rate goes down and DeFi continues to have a large gap in the yield it can provide because of the demand for US dollars in the DeFi ecosystem, that is actually the largest driving force of DeFi total value locked, or assets under management is how you would put it in the traditional world. Right now, the total value locked in DeFi is at 360. It's fluctuating as high as 380, 386. Those are all-time highs. That's because of the yield rate you can get in DeFi. Now, if the yield rate for the US dollar disappears more and more in other places, and it remains even reasonably high in DeFi, and access to DeFi, the rails and the user experiences to access DeFi become more accessible. So the friction goes down. That means more people can access that yield. Then the total value locked within DeFi could grow past 500 billion, past a trillion. And that's the historic largest force. Is the ability to gain yield on assets in DeFi versus in centralized and traditional methods.
Okay. Now, we're talking about a world in which people are viewing not just Fed policy, but also trade policy to make financial decisions. Now, you're building infrastructure that essentially operates on a financial system without central banks or political interference or pressure. How do you view this moment where traditional monetary policy is trying to manage risk while DeFi is potentially offering an alternative way to manage financial risk altogether? In other words, is this the pivotal moment where we have massive institutional and retail flows into the DeFi world to mitigate risks away from uncertainty around trade and monetary policies?
So there's a few things going on there with monetary policy and trade policy. The biggest impact that monetary policy has had is all the money printing and the PPP checks and things like that, which many people put into crypto assets. That floated the price and value of crypto assets much higher, which then did capture a sufficiently large portion of institutional attention. That institutional adoption of crypto grew. One good example of this is stablecoins. So stablecoins, when they were at below 0.5% of all US treasuries, were not that interesting to the US government. Once they crossed 0.5%, the US government started to take a lot of notice because it's the treasury market, right? It's the core market the US government cares about and sees as a national security priority. So all of that cheap money flowed into crypto. You need stable coins to trade in crypto. So the stable coin kind of volume grew. That grew the share of treasuries. And then growing the share of treasuries, it legitimized blockchain technology for the government and for the capital markets. Now, the trade policy force is much more a force of deglobalization. And so, separately from monetary policy, I feel that crypto currencies and stable coins and what are known as real world assets or digital assets, which are the capital markets versions of cryptocurrencies, are all going to be much more useful in a deglobalized world. Because in deglobalized world, what happens is you start to shut down the existing rails. So when you start shutting down the existing TradFi rails, or you make them harder to use, or you make them less able to transact with, people already now look towards crypto rails and stablecoin rails as a frictionless alternative. You can see this in some of the cross-border payment developments. You can see this in the adoption of stablecoins like Tether in emerging markets that don't want to get on traditional rails. So the deglobalization force is driven by the trade policy of the president. That does create demand for an alternative financial system for payments, transfer of assets, and everything the financial system does. So those two forces right now are both very pro crypto, right? Because the monetary policy force is still printing money, is still putting out, a large amount of risk on appetite for valuation growth. And the trade policy force is creating a lot of deglobalization fears. And so people are asking themselves, well, could I use a stable coin to pay an invoice instead of being in some system where, because of deglobalization, they could turn off the system? So both of those forces are extremely pro crypto, pro blockchain, pro real world assets, pro stablecoin right now.
If you've been watching Solana rise this year, you might want to check out today's sponsor, Upexi. Upexi is a NASDAQ listed company that's taking a long-term approach to crypto. Earlier this year, they announced a strategic shift to include digital assets in their treasury with a particular focus on Solana. Today, they hold one of the largest Solana treasuries of any public company and are actively staking their holdings to generate yield rather than letting assets sit idle. Their Solana holdings are valued at over $447 million with a daily yield of approximately $105,000 in staking rewards. They're also backing smart crypto infrastructure like Alpha Exchange, a new platform blending AI tools with real-time trading data and tight security. For investors looking for publicly traded ways to get exposure to Solana's momentum, Upexi might be one to watch. Check out their investor presentation and latest updates using the link in the description down below or scan the QR code here. So this is what, well, first of all, before I'm going to show you a statement from Scott Bessent, Treasury Secretary, but what is, in your opinion, the future of stablecoins? Will it mostly be reserve-backed, or will we see a resurgence in popularity of Algo stablecoins? In other words, a return of something like Lunaterra?
So you already have a return of Algo stablecoins through things like Athena and a few others that provide you the yield with like delta neutral type strategies. So that return has happened already. It's managed on the risk side a little bit differently, but it's kind of Algo stablecoins are definitely doing well and growing. You also have a growth in reserve-backed stablecoins, which the Stablecoin Bill, the Genius Act, requires them to be backed by treasuries. So you definitely have a growth in treasury-backed stablecoins, and that's really significant because those stablecoins will keep eating more of the treasury market, the U.S. treasury market. When I looked into this last year, I think stablecoins as a group were the 18th largest holder of U.S. treasuries. I think above Japan and below Germany, so somewhere in the 18th spot. I'm positive they've grown far past that point now because of the growth in stablecoins. The projections on stablecoins right now are anywhere in the 1 to 4 trillion range, while right now they're in the hundreds of billions, 1 to 300 billion. So I think Algo stablecoins will definitely be here. They'll still need collateral. And in many cases, that collateral will still be treasuries. And the treasury-backed stablecoins are definitely going to grow because they're the most legitimate form of stablecoins, which through the Genius Act, the US government is, I wouldn't say requiring, but highly encouraging.
Yeah, so this leads me to Scott Bessent's statement. This groundbreaking technology, he's talking about stablecoins, will buttress the dollar's status as the global reserve currency, expand access to the dollar economy for billions across the globe, and lead to a surge in demand for U.S. treasuries. I believe you said in another interview on Altcoin Daily that we can see tokenized cash grow from 200 billion to 2 trillion relatively quickly. So going back to Scott Bessent's statement, what will exactly happen to demand for U.S. treasuries? I mean, is it necessarily true that we're going to see more demand right off the bat? Is it going to be phased in? Is it going to take on various other forms? Or is this just another way to sell U.S. assets to the world by the administration?
There's going to be a huge surge in net new treasury purchases from the stablecoin community. I think what will happen is the existing treasuries out there will be given to them as collateral. And so there'll be downstream effects where the people that give them the treasuries, like the custodians and the banks, they end up buying more treasuries to fill the demand. But I think that'll happen gradually. I think it's really valuable for the US government as a source of diversification of who holds the treasuries, because the consistent concern of many people in DC is the treasury market's vulnerability to countries dumping US treasuries. And so the difference between stablecoin holders and countries is that if you have a few 100 million or billion stablecoin holders, they all got to make a decision at the same time, right? Which is kind of not as easy as a single country or a single central bank saying, I'm going to dump my US treasuries. So I think it's also viewed as a kind of diversification by the US government away from governments holding the US treasury and onto consumers holding the US treasury. And not just US consumers, but global consumers, which fundamentally what that does is it puts the US dollar in more people's hands, which has a net beneficial effect of contributing to the perception of the US dollar as stable, which is, or at least as a safe haven, high value, stable asset, which is kind of, what the US dollar needs most is that perception. And so the more people you get to put their savings in the US dollar, the more you presumably buttress that perception.
I'd like you to get your response, please, to this clip. It's Special Advisor to Putin, Anton Kobiakov. He's kind of alluding to the fact that the U.S. is using stablecoins to devalue the dollar and wipe out its death. Take a listen.
Америка прямо сейчас пытается поменять правила на рынке золота и криптовалют. Вспомните, какой у них долг. 35 триллионов долларов. В общем-то, это два альтернативных валютному сегменту мировых рынка. Действия Вашингтона в этом направлении отчетливо демонстрируют одну из главных американских задач. Они очень хотят решить проблему снижения доверия к доллару. США, как это было и в 30-е, и в 70-е годы, будут решать свои финансовые проблемы за счет всего мира, загоняя всех куда? В криптовалютное облако. Со временем, когда часть госдолга США будет размещена в стейблкоинах, США обесценит этот долг. Еще раз простыми словами, у них сейчас валютный 35-триллионный долг, они его загоняют в крипту, в облако, обесценивают и начинают с нуля. Это для тех, кто очень любит заниматься криптой.
Pushing everyone into the crypto cloud. What's your immediate response to what was just said?
even if the US revalues all of its gold to $15,000, it doesn't make enough of a dent. And when you look at its Bitcoin reserves and other digital asset reserves or stockpile, it makes less of a dent. So it's just the numbers aren't big enough for something like that to work. It isn't the arithmetic isn't there. You know, you can the highest repricing value that I've heard for the gold reserves is $15,000. That's the highest number I've heard floated around. Even at that number, that 35, 36 trillion doesn't, you know, you don't reduce that by even 10%, 20%. It just doesn't happen. So it's not the arithmetic doesn't work on that theory working or not working. It wouldn't make a big enough dent.
Well, you were in the room actually when the Genius Act was signed. Ultimately, if someone were to say, a layman were to ask you, hey, Sergey, I'm just following the space, I'm just following the news, and I'm wondering how exactly the landscape of U.S. commerce is going to change following the enactment of the Genius Act. In other words, once stablecoins becomes more mainstream, once we have a large number of real-world assets tokenized en masse, how will that ultimately change the U.S. economy? How would you answer that very broad question?
I think it's really the next generation of the financial system, the U.S. financial system. And the question really is whether the U.S. is going to adopt tokenization of their current financial system and what the market share gain or loss of the United States financial system is going to be relative to the global financial system. So my view is that the tokenization of cash through stablecoins, tokenization of equity, tokenization of commodities, the tokenization of funds is an inevitable outcome for the global financial system. And this type of reformatting of the financial system only happens every maybe 50 years, 50 to 70 years. Last time it happened was basically in the 70s, something like that, with the appearance of the first databases and computers in the financial world. So during that migration of the financial system, the US, because they had the internet and they were leaders in the database industry and the internet industry, were able to, put their financial markets on the internet before others. And that led to a lot of success and market share gain for the US financial system relative to the rest of the global financial system, right? As a share of it. I would say it's pretty much the same situation. So the financial system that tokenizes and creates all the efficiencies and benefits of tokenizing cash, equity, commodity, and funds is going to gain share. Now, obviously, their existing position in the financial system and having a big domestic market like the US has, and having relatively well-regulated and stable legal systems and markets like the US has, that's all obviously a huge benefit. And so that's a very serious foundation, which, someone else could come and erode by tokenizing more than the US or faster or better. But if the US tokenizes faster and better than all other economies with the large financial market they have and the stable regulatory environment and relatively low levels of fraud that they have relative to other markets, then I think the US financial system's market share of the global system grows, which is something, by the way, that now it's pretty clear to the folks in Washington, D.C. Thanks also partly to them.
On this road to tokenization, Chainlink is playing a big role. So just last year, for example, Swift, UBS Asset Management, Chainlink successfully completed innovative pilots to bridge tokenized assets with existing payment systems, according to a press release. Tell us about your partnership with large financial institutions and ultimately why financial institutions are working with Chainlink on this journey.
Sure. So Chainlink has enabled over 25 trillion US dollars in transaction value, been live on production for well over 5 years now, secure and reliably operating. There's no other system like Chainlink that can say that. And also Chainlink has all the different capabilities that banks and asset managers and financial market infrastructures all need in order to do complex transactions. So blockchain transactions in the Web3 retail world are relatively simple. I'm on a chain, you're on a chain. We don't need to identify each other. We don't need to go through any pricing process. I send you my 3 cat coins. You send me your 5 dog coins. The Bitcoin price goes up and we all make money. Great day for us. In the traditional financial world, however, you have accounting requirements, you have security requirements, you have data requirements, you have all kinds of identity requirements. All those requirements need to be met by what's called an oracle or an oracle network, which is what Chainlink pioneered. And so basically, Chainlink is the only system that can provide all those things that I told you in a single system. So only with Chainlink today can you make a token that's enabled cross-chain, connected back to identity, getting reliable valuation data about the value of the underlying asset, that's also compliant with the regulator, and that meets all the accounting and books and records requirements for the transaction to happen. Those are all requirements that you don't have in Web3, but you do have in the TradFi world.
How far away are we until banks, large banks, put deposits and assets on chain, such that when I'm wiring somebody money, it's done through the blockchain?
JP Morgan already has tokenized deposits on chain. There's a number of other large banks that have tokenized deposits in their internal systems. There is definitely a trend to go into production now, this year and next year. So I would say we're now at the stage of production implementation of those things. There are already banks with private chains where they use them to settle their internal client transactions. So in some form, these volumes are not public, but they already exist. If you're talking about public chains, I would say that this year and next year are the time.
And do you think in the future, when this happens, consumers will, or bank users will have a choice between whether or not to put their deposits on chain, or will it happen automatically behind the scenes with all deposits?
I think initially there'll be a choice, and there'll be a separate product and a separate experience, because it'll be built by a separate team that's offering all kinds of digital asset things. And they'll carve out a category of the banks and the asset managers users who want exposure to those blockchain things. I think eventually it's inevitable that it just powers everything, and so it becomes a completely given outcome. It's not like you choose what database the bank runs or how they secure that data. Like, this stuff is not really something you care about, right? You just care about a transaction, you care about yield, you care about cybersecurity, but they don't tell you how they do the cybersecurity. They just kind of do it. I think it's inevitably going to become how everything works, and then there won't be a choice. The challenge for our industry is in the early stages here in the TradFi world to show value, operational value, clearing and settlement value, the value of better collateral management, basically utility for tokenized things that isn't just about the speculative value of the tokenized thing going higher. That is what I think is now going to get proven out, is that, oh, okay, when I own an equity over here, I can only trade it 5 days a week. When I own a tokenized equity, I can trade it 24/7, 365. Oh, look at this. When I have a tokenized, when I have a traditional fund, I can't post it as collateral. When I have a tokenized fund, I can post it as collateral. Isn't that nice? Oh, look at this. I have a tokenized commodity contract. I can use it. I can use the value there and relate to the collateral management system, which is on only 21 hours, 5 days a week. Or if I have a tokenized version of this commodity contract, I can do collateral management 24/7, 365. Oh, look at that. Isn't that nice? So all of these things require an ecosystem, and that ecosystem is now coming into existence.
Where will these tokenized funds, equities, stocks, bonds, assets be traded? Is this still going to be on the same exchanges, or are we looking at completely different exchanges and clearinghouses for these products?
Everywhere. That's the fascinating thing about our industry. There's a certain transparency benefit, which, by the way, regulators love, whether they know it or not. Some of them do now, some of them still don't. So the transparency benefit is there. There's the trust minimization and tamper-proofness benefit, where transactions can't be manipulated. Everyone loves that, whether they realize it or not. Then there is also the permissionless innovation benefit. And I want to be clear what that means. That doesn't mean that anybody can just do anything. You will have contracts on chains that require AML KYC verification in order for you to join that liquidity pool or for you to trade in that venue. But the difference is that everyone can spin up that venue or that liquidity pool in a lot of places. Now, I still think there will be a lot of value in brokers, in the onboarding process, in advice, in the ability to aggregate liquidity into active markets and venues and liquidity pools. That will all have value. But I don't think that'll be inherently exclusive anymore to certain specific clearing and settlement systems or venues or a lot of other systems. I think the challenge now will be, how do you provide value separate from those core services of clearing and settlement or collateral management? Because everybody just gets that out of the box.
And just on that note, let's talk about ISO 20022. It's a global standard for financial messaging that's used as a universal language for the financial industry. Many people don't understand its significance, though. Can you just explain in plain English why it matters for global payments and tokenization? And for the second part of the question, in Swift's pilot, UBS's digital transfer agent raised a subscription and redemption on-chain, and then Swift's transaction manager triggered an ISO 20022 payment message. So how does Chainlink fit into making that workflow seamless?
Sure. So ISO 20022 is kind of like the English language of financial transactions. Like you and me are speaking English now. We can communicate. And banks and asset managers and all the systems in finance, they need to communicate. And they need a standard way to send each other, requests and information and define transactions. And that's the 20022 kind of set of standards. Swift is that set of standards for specific message types on specific topics. And what Chainlink does is it converts those ISO 20022 Swift messages and others into blockchain transactions and events. So one of the things that Chainlink does is it takes existing financial infrastructure and systems like Swift, and it converts them into blockchain events so that the Swift system can properly execute the necessary blockchain events. And then the reason that's valuable for UBS is that UBS and a lot of other banks and institutions are already on the 20022 standard, and there's no reason to get rid of it, right? So instead of describing in the ISO 20022 standard, I want to do this transaction and I want to execute my clearing and settlement operation over there. Now you describe the same transaction, except you say, I want to execute on a blockchain. But then something has to execute it on a blockchain for you, which is what Chainlink does. So Chainlink will take the Swift message, and it'll essentially affect it on chain, and then return all the proof back to the system, to the Swift system, and therefore get it back to UBS.
I see. All right, just going back to tokenization of real-world assets one more time. This is a message. Well, this is a question from a viewer directly to you, actually, Sergey. He's asking you to respond to what Larry Fink of BlackRock said. Take a listen.
We'll have to approve an Ethereum ETF. And is that a function of something the SEC has to do, or do you think that all these things have to go to court first?
I couldn't respond to that. I see value in having an Ethereum ETF. As I said, these are just stepping stones towards tokenization. And I really do believe this is where we're going to be going. We have the technology to tokenize today. If you want to think about this. If you had a tokenized security and you have a tokenized identity, right, you, Andrew, the moment you buy or sell an instrument, it's known. It's on a general ledger, right, that is all created together. You want to talk about issues around money laundering and all that. This eliminates all corruption by having a tokenized system.
Okay. The question specifically is, Fink said, we have the technology to tokenize today. What is this technology he's referring to?
I would say it's smart contracts, blockchains, and Oracle networks like Chainlink. All of the technologies need to work together. The blockchain is essentially the data, the data store of the transaction and the ledger. The smart contract is the token itself and how the token behaves. And then the Oracle networks are the connection point to all the data to value the token, the ability to move the token across chains, the ability to add identity to the token. So, for example, he mentioned adding identity to the token or to a token transaction. You can't add identity without an identity oracle, which Chainlink is a very large provider of. So you are basically in a world where, the blockchain's like this public shared ledger database. The smart contract is the actual financial terms of the agreement, the actual ownership record. And then the Oracle networks are all the systems around the contract that need to operate for it to successfully do what it's supposed to do. Value the contract, move the contract across chains, provide identity proofs, so on and so on.
I'd like to talk to you about Chainlink's partnership with the government. Now it's becoming closer and closer with the government. So last month, I believe, a major announcement was released where there was a partnership with the government and key economic data, including GDP data from the Bureau of Economic Analysis, PCE index, and private sales, private domestic purchases are now accessible on chain through Chainlink data feeds. Can you tell us about this initiative and ultimately why you're partnering with the government to do so?
Yeah, absolutely. Happy to chat about it. So we work closely with different regulators, different departments of the U.S. government, thinking with them and working with them on how they're going to adopt smart contracts, Oracle networks, including how they're going to get data on chain. In this case, it was about putting economic data on chain for the U.S. Commerce Department as the kind of largest provider of that service and providing the most data from the U.S. Commerce Department onto the most chains. We were able to provide valuable data set essentially to the blockchain community, which is what the U.S. Commerce Department wanted. Right? They wanted the blockchain community to have access to this data and to build things around it. And we're still working through how to go to the next stage and how to get more and more of the blockchain community building on this data. There's a lot of other engagements and work and conversations we're having with the U.S. government, different departments, different regulators, our work with many central banks in other countries, and our work with the largest financial institutions, I think put us in a pretty unique place to work with the regulators and the departments of the U.S. government, which I think they share that view as well.
Economic data, as you know, the releases are incredibly time sensitive. A lot of traders stake millions, if not billions of dollars trading data that comes out at exactly a certain time of the day, pre-scheduled. How can you ensure that Chainlink's decentralized Oracle network can match that level of precision when it comes to data releases on chain across multiple blockchains, that is? Sure.
Well, the data is coming from the official U.S. Commerce Department APIs. So that's the data source. And then it's a matter of the Oracle networks doing what they're supposed to do and publishing the data in a timely fashion. And the Chainlink network has the best uptime, the most timely delivery of data across the many, many chains. And it's the longest running Oracle network with the best track record. So I think the track record we have for delivering this data reliably speaks for itself.
Finally, you mentioned in another interview that we're kind of mirroring the internet era of crypto and DeFi adoption. So what's next per your projection? We've got the stablecoin trend. We've got the real world asset tokenization trend. What do you think the government is planning next after the Genius Act? What is the next landmark legislative change that we can look forward to, Sergey?
That's the market structure bill that's currently being worked on in the Senate. And that is about clarifying how regulation applies to cryptocurrencies and tokenization on blockchains in general. I think what that'll do is it'll legitimize the issuance of a token, the creation of a cryptocurrency, the launch of a meme coin, the launch of an NFT, and make it legal and eliminate the legal risk of launching a cryptocurrency, launching a meme coin, launching an NFT. I think it'll also provide some comfort to those that want to make digital assets. So tokenized equity, tokenized commodity, tokenized funds. It won't completely comfort them because commodities, equities, and funds have long-standing regulatory guidance and laws and rules that still need to be meshed even after the bill is signed. But I definitely think the market structure bill will be a huge step forward. It won't just be about stablecoins; it'll be about all tokenized things, and I think that'll be a big milestone for our industry. That's definitely what's next. I know that's definitely what the White House is focused on. That's definitely what folks in the Senate, Banking and Finance Committee, and other committees are focused on, who we talk to regularly and have good conversations with about the importance of this bill, and would really like to see it, come to fruition.
Final question. Are we witnessing the moment where blockchain stops becoming the technology for just cryptos alone, but is now the technology where will soon become the technological backbone for the entire financial system and not just for the crypto asset class?
Yes. I think what's going to happen now is you're going to have enough tokenized cash to create enough market demand for more tokenization of real world assets. So the bigger the stablecoin market gets, the more of a market you have to easily sell digital assets to, right? So if you have a market of 200 billion, that's one thing. If you have a market of 2 trillion, that's another thing. That's going to encourage the creation of more digital assets that can be easily and frictionlessly bought via stablecoins. Once the digital assets, the real world assets appear, you will start to see the growth of an ecosystem around trading, secondary markets, various exciting new forms of collateral management. And I think when this ecosystem appears, what you'll see is that the benefits of a tokenized equity, a tokenized commodity, and a tokenized fund so far outstrip what a traditional equity, traditional commodity, and traditional fund are capable of, that everyone will just say, like, look, I really would prefer if you could give me this equity as a tokenized thing. Or I really would like it if you could do it for me, if I could get this fund in a tokenized form, because then I can post it as collateral, which is valuable to me because, it saves me cash, it saves me stuff on the other side. I think once that ecosystem provides that utility value of tokenized financial products and smart contract powered financial relationships, there will be a kind of realization moment where the financial system says basically what you saw Larry Fink say, which is like, this is way better, right? Larry Fink basically looked at it and said, this is way better. And I'm sure it's way better. And the rest of the financial system, they're so busy doing what they're doing on a day-to-day basis. They're not as deeply thoughtful as Larry Fink. They haven't looked into it. But once they start using it, they won't have a choice. The system will provide them the value, and they can't ignore it anymore because the value is there. That ecosystem of secondary markets, trading venues, collateral management relationships, smart contract risk relationships, automated risk management, automated compliance, it doesn't exist yet. Chainlink is powering a lot of the first pilots of it and first production usages of it. But once it exists, it's going to speak for itself.
Final question, I'll let you go. I wonder how this would impact geopolitics. You know that, as you know, the U.S. has weaponized SWIFT, has weaponized the dollar. It is able to use the SWIFT system to sanction a lot of countries around the world, including Russia, including North Korea, including Iran. If everything moves on chain, the U.S. loses that power. What happens next?
I think the U.S. will be well served to capture as much of the crypto market as humanly possible. There isn't anymore a world in 20, 30 years where people don't have a choice. I think they have a choice. I think the question is, does your financial system have the best stuff for them to choose from. And if enough of them are in your financial system, then your financial system is really important. And if your financial system doesn't have the best stuff, then it's not so important.
Okay, thank you very much. Sergey, where can we learn more about you and follow your work in the meantime?
Chain.link. On Twitter, it's Chainlink. And my Twitter, what is my Twitter? I think it's my first name and my last name, Sergey Nazarov.
We'll put the X handle down below.
Thank you.
We'll find it for you. Yeah, it is your first name and last name. And so yeah, make sure to follow Sergey there. We'll put the links down below, and appreciate your time, Sergey. It's a pleasure meeting you, and thank you for coming on the show.
My pleasure. I appreciate your thoughtful, well thought out questions. Thank you.
Thank you. And thank you for watching. Don't forget to like and subscribe.